There is a particular kind of financial wound that does not bleed until you believe you are already safe. You have done the responsible thing. You have delayed gratification, paid your taxes honestly, and placed your trust in a promise the United States government made to you in the fine print of the Internal Revenue Code, a promise that your money, once sheltered inside a Roth IRA, would emerge in retirement as clean and untouchable as the day is long. You have earned that money. You have already surrendered your share to the Treasury. And then, on the morning you reach into the account you spent decades building, something arrives that should be impossible. A tax bill, on Roth money, yours. This is not a bureaucratic error. This is not a clerical misunderstanding. This is the IRS operating precisely as designed, collecting on a rule so poorly understood, so rarely explained with any honesty or clarity, that millions of careful, disciplined, well-meaning Americans walk directly into it every single year. They walk in not because they were reckless, not because they ignored their finances. They walk in because someone, at some point, handed them a beautifully simple idea: pay taxes now, withdraw tax-free later, and called it a complete explanation. It was not. It was, at best, the opening sentence of a story with two very important paragraphs still missing. Those paragraphs contain what the IRS calls the 5-year rules. That plural, rules, is itself the first deception, because most people who have heard of this at all have heard of a 5-year rule. Singular. One rule. One clock. One waiting period, and then the gates open and everything inside is yours. That is the version passed between friends at dinner tables and repeated in casual conversation as though it were settled law. It is not settled. It is not even accurate. There are, in fact, two entirely separate 5-year clocks built into the architecture of the Roth IRA, each starting at a different moment, each governing a different category of money, and each capable of delivering a tax consequence or a penalty that you were absolutely certain you had already escaped. To understand why this matters so completely, you must first abandon the comfortable fiction that a Roth IRA is a single homogeneous pool of tax-free dollars. It is not. The money sitting inside that account is actually composed of 3 distinct and legally separate categories, each treated by the IRS with its own set of rules. There are your contributions, the dollars you personally deposited, the ones on which you have already paid income tax. There are your conversions. Funds transferred from a traditional retirement account on which you paid tax at the moment of conversion. And there are your earnings, the growth, the compounding, the accumulated return on everything that came before. 3 categories, 3 sets of rules, and the catastrophic mistake that costs retirees real money, real peace of mind, and real security is treating all 3 as though they are indistinguishable. The first of the 2 clocks governs your earnings. It answers one question and one question only. Will the growth inside your Roth come out tax-free, or will the government take its share after all? The answer depends on 2 conditions being satisfied simultaneously, not one, both. The first condition is a qualifying reason for withdrawal, and for the overwhelming majority of Americans, that qualifying reason is being at least 59.5 years old. The second condition is that your Roth IRA must have been open for at least 5 tax years, counting from the very first time you funded any Roth account, ever, anywhere. Not 5 years since your last contribution, not 5 years since you opened your current account, 5 years since the first dollar entered your first Roth. And here is where the trap closes on precisely the people who deserve it least. The retiree who opened a Roth at 58, having finally reached a financial position that made it sensible to do so, who then turns 61 and withdraws some of the growth in the full and rational belief that being 61 satisfies every possible requirement, that retiree is wrong. The age is satisfied, yes, but the account is only 3 years old, the earnings clock has not finished, and the growth that comes out gets taxed as ordinary income, not because of any recklessness, but because of a clock that was never explained, and a rule that operates in complete silence until the moment it does not. The profound, almost elegant cruelty of this rule is its timing. You cannot go backward and start the clock earlier. You cannot negotiate with the IRS about when the 5 years should have begun. The only cure is time, and time already spent is the one currency that cannot be recovered. The only remedy, then, is prevention. And the prevention is almost embarrassingly simple. Open a Roth IRA. Put something in it. Anything, even a modest amount. The precise dollar figure is irrelevant. What matters is that the action of funding starts the clock. That clock, once started, is a single lifetime clock. It does not reset. It does not pause. It runs forward in the background, through market cycles and life changes and years when you add nothing at all, quietly accumulating the one thing that eventually makes your earnings completely untouchable. And the people who start it early, even without fully understanding why they are doing so, arrive at retirement with a 5-year rule that has already solved itself. The trap simply does not exist for them, because they started the clock before they knew they needed to. If the first rule is a clock that quietly governs your earnings, the second rule is a trap that specifically targets people who did something intelligent. It targets the converter. It targets the retiree who looked at a traditional IRA full of pre-tax dollars, studied the tax landscape, recognized that moving that money into a Roth, paying the tax now during a lower income year, was a sound and strategic decision, and acted accordingly. It targets, in other words, the person who was paying attention, and it does so with a mechanism so counterintuitive that understanding it requires setting aside almost everything you think you know about how the Roth is supposed to work. Here's the rule in its plainest form. Every Roth conversion you execute begins its own separate 5-year clock, starting on the 1st of January of the calendar year in which the conversion occurred. If you withdraw those converted dollars before that individual clock has completed its 5 years, and if you are under the age of 59 and a half, the IRS will impose a 10% early withdrawal penalty on the amount you pulled out. Not a tax on the conversion itself, you have already paid that. A penalty. On money you already paid tax on, because you reached for it too soon. The reason this rule exists is almost darkly logical. Before it was enacted, a certain arbitrage was theoretically available. A person under 59 and a half, wishing to avoid the 10% early withdrawal penalty on a traditional IRA, could convert the funds to a Roth and then immediately withdraw them, having neatly sidestepped the penalty. The 5-year conversion clock was Congress's answer to that maneuver. It is, at its core, a penalty on impatience, a rule that says you may convert, you may pay your taxes honestly, but you may not immediately reclaim the funds and call yourself penalty-free. You must wait 5 years, or until you reach 59 and a half, whichever arrives first. This is the rule that catches early retirees, the man who leaves the workforce at 55, who converts a portion of his traditional IRA because he is in a lower tax bracket and the strategy is sound, and who then, needing funds to live on, withdraws that converted money 2 years later. That man is under 59 and a half, his conversion clock has not completed, and the 10% penalty arrives with a precision that feels almost punitive in its indifference to his good intentions. He did not fail to plan. He simply planned without knowledge of the second clock, and that missing piece of information cost him a portion of money he had every reason to believe was his. What makes this doubly disorienting is the nature of multiple conversions over multiple years. Each conversion carries its own clock. Convert in 1 year, then the next, then the year after that, and you have 3 separate 5-year timers running simultaneously, each beginning on the 1st of January of its respective year, each completing on its own independent schedule. Pull money from the most recent conversion while the oldest is already penalty-free while being under 59 and a half, and you have tripped a trap while standing next to money that posed no danger whatsoever. The dollars look identical inside the account. The clocks are not. This is precisely why a written record of conversions is not merely good practice. It is, for the early retiree living on converted funds, something close to financial self-defense. A simple log, the year of each conversion, the year its clock completes, transforms an invisible tangle of overlapping timers into something visible, navigable, and manageable. The people who keep this record almost never get surprised. The people who trust their memory or who assume that one Roth clock covers all Roth money are the ones who receive the penalty notice and have no recourse but to pay it. Now, before we move forward, if what you're reading right now is revealing things about your own Roth that you genuinely did not know, you are in the company of millions of Americans who were handed a powerful financial tool without being handed the instructions. If this is landing for you, if this is the explanation you have been looking for, do one thing right now. Subscribe. Because the rules that govern your retirement income, your Social Security timing, your required minimum distributions, your inherited IRA, none of them are explained this clearly anywhere else. The next one is already coming, and it will matter just as much as this one. There is, however, genuine relief embedded in the second rule, and it deserves to be stated plainly. Once you reach 59 and a half, the conversion clocks stop mattering entirely. The penalty applies only to those who are both under that age and withdrawing converted funds before the individual clock has completed. The moment you cross that threshold, your converted dollars become as accessible as your contributions, and the second rule recedes into irrelevance. For most retirees, the conversion clock is therefore not a permanent concern. It is a temporary one, serious, consequential, and entirely avoidable with proper planning and timing, but temporary nonetheless. And there is one more gift concealed in the mechanics of these clocks. Because both the earnings clock and the conversion clocks begin on the 1st of January of the relevant year, a conversion executed in December is treated as though it began on the 1st of January of that same year. In practical terms, a conversion done late in the calendar year may complete its 5-year waiting period in barely more than 4 actual years. It is a small arithmetic grace, free for the taking, requiring nothing more than the knowledge that it exists and the timing to act on it. A conversion done in January and a conversion done in December begin their legal 5-year journey on the same date. December captures nearly a full year of progress before the first calendar page has even turned. The tax code is not sentimental. It does not reward good intentions. It does not issue credit for years of diligent saving or for the admirable discipline of delayed gratification. What it does, with a consistency that is almost architectural, is tax the uninformed and exempt the prepared. And nowhere in the landscape of retirement planning is that dynamic more cleanly illustrated than in the ordering rules that govern Roth IRA withdrawals, rules that are almost never discussed but that quietly protect the majority of people who understand them. When you withdraw money from a Roth IRA, you do not get to choose which category of dollar comes out first. Neither does the IRS. The order is fixed by law, and it runs as follows: contributions first, conversions second, oldest to newest, and earnings last. This sequence is not incidental, it is profoundly protective, because contributions, the dollars you personally deposited on which you have already paid income tax, are always available, at any age, without tax and without penalty, regardless of how long the account has been open and regardless of either 5-year clock. Always. The clocks do not touch contributions. They cannot. The government has already collected what it was owed on those dollars, and it has no further claim. The consequence of this ordering is that for a retiree who has spent years making direct contributions to a Roth, there exists a substantial cushion of money that can be accessed in retirement with complete freedom. The two 5-year rules exist somewhere deeper in the account, in the converted dollars beneath the contributions, and in the earnings above them all. But as long as a withdrawal stays within the contribution layer, neither clock is even relevant. The trap is real. For many people, the trap is also unreachably far below the surface. Consider what this means in practice. A retiree who has contributed steadily to a Roth for many years has built a base of completely accessible funds that serves as both a financial resource and a kind of protective buffer against the rules below it. Before that retiree ever touches a dollar of converted money or a dollar of growth, they can draw freely on everything they personally deposited. And because the ordering rule places those contributions at the front of every withdrawal, every dollar taken out is treated as a contribution first until the contributions are fully exhausted. The clocks are simply bypassed, not by a loophole, but by the structure of the law itself. Understanding your layers, then, is not an accounting exercise. It is a navigational tool. Knowing how much of your Roth consists of contributions, how much of conversions, and how much of earnings tells you exactly how far you can reach without activating either clock. It answers the question that most people answer with anxiety and a guess, with a clear and honest number. And for a great many retirees, that number is larger and that safe zone is wider than they ever feared. There are, of course, those who will come to this knowledge later than they would have wished. The person who is reading this at 60 and has only just opened a Roth. The person who converted money last year without writing down the date. The person who has been pulling from their Roth for several years under the assumption that all of it was tax-free and is now uncertain whether they have been wrong. To those people, a clear and honest reassurance. The earnings clock, the one that matters most for retirees, is a single lifetime clock that may already be running. If you opened any Roth account in the past, at any institution, the clock started then. It has been aging quietly without your participation. You may already be past 5 years and simply not know it. And if you are not, your contributions remain entirely available to bridge the gap while the clock completes. The inherited Roth also deserves a moment's attention because the 5-year earnings clock does not extinguish at death. It passes forward. A Roth that has satisfied its 5 years can transfer its earnings tax-free to the people who inherit it. A Roth that has not creates a tax obligation for the very people you are trying to protect. Starting the clock early is therefore not merely a gift to yourself. It is, in the most literal financial sense, a gift to the people who will one day receive what you have built. This entire conversation reduces, in the end, to a truth so simple that its repetition risks sounding reductive. The Roth IRA is one of the most generous instruments in the American tax code, and its 5-year rules are not punishments. They are instructions. They are the fine print on a remarkable offer, and like most fine print, they only damage the people who were never told to read them. You have now read them. You understand that your Roth money is not one thing, but 3. You understand that one clock governs your earnings and started the day you first funded any Roth. You understand that a second clock applies separately to each conversion and that it matters primarily when you are under 59 and a half. You understand that your contributions are always first in line and always free. And you understand that the difference between the retiree who receives a surprise tax bill and the retiree who does not is almost never luck or wealth or financial sophistication. It is information. So leave a comment below and tell me. Did you know before today that there were 2 separate 5-year clocks? Or did you believe, as most people do, that there was only one? Your answer might help someone else in this community realize they need to read the instructions before they open the account rather than after. That single piece of shared awareness has real financial value, and conversations like this one are how it spreads. And remember, this is for education and discussion only, not personal financial advice. Your specific situation involves details that only a qualified CPA or financial advisor who knows your full picture can properly evaluate. Use this understanding to ask better questions, to walk into those conversations informed, and to ensure that the money you worked a lifetime to build stays exactly where you intended it, yours.